Welcome to Diamond's Edge Live. My name is Greg Diamond, and this is a weekly trading show. We'll talk technical analysis, we'll talk trading. This is the second episode. Last week, I kind of went over the basics. I just want to do a quick recap. If you haven't seen it, if you're new, you can look back on that and just kind of go over some of the basics that we talked about. Specifically, we looked at the three tenets of technical analysis that I use. That is time, WD Gann, that is price, Elliott Wave theory, and then the indicators, momentum indicators, okay? So again, that's important to go back and probably look at that. Because every week I'll be going over those things in one way or another. And this week I'm going to look at a few different things. We're going to incorporate how to use Fibonacci retracement zones, confluence zones of Fibonacci retracements. I think is important, and I'll show you how I combine those with both Elliott Wave and the indicators. And then we're going to look at some live stuff. We're actually going to do that right now. So let me share my screen here, okay? And what I want to show you, so we looked at, this is really good because we have volatility over the last few days. And so let me pop this up here, okay? And this is the S&P 500. And over the last few days, we've seen this down move, okay? And last week I covered a lot about the basic principles of Elliott Wave. 5 waves down, 3 waves up, okay? Now, with this down move, what I want to show you, and I'm just getting right into this here, okay, is how this price action translates into Elliott Wave principles, how it translates into the rules. And as I mentioned last week, when we look at kind of what Paul Tudor Jones said, it is both a trading strategy and a risk management system. This is a perfect real-time example of exactly what he's talking about. All right, so we'll look at here, and let me I'll zoom this, get these out of the way so you can just see the price action here. Okay, and what we're looking at here, okay, this is the big drop, 1, 2, okay, and then we had this huge move down, okay, over the last few days. Now look how I've subdivided this out. Okay, so the bigger Roman numeral in parentheses, the bigger wave, 1, 2, and again, just to go back, if you wanted to day trade this, all right, what would you do? If you were to see that this was wave 1 down, you would place a short here, and this would be your stop above, call it 6150 on the S&P 500, all right? And then you would have captured this entire third wave move down, all right? So within this third wave move down, you can see near at the bottom, I've highlighted this wave 3, okay? I'll zoom in here. All right, and then within this wave 3, and I mentioned this last week as well, and you'll see this is up here at the top, this is a 30-minute, 1-minute chart, okay? So each bar is 30 minutes, all right? But if you go down to a 1-day, you could subdivide all those as well, all right? And they really stick out when we have volatility, when we have these big down moves. That's where I think Elliott Wave works the best. Does it work in up moves? Absolutely, no doubt about it. But for me, I love the volatility within crashing markets or down markets, if you will, because it just seems a little clearer. And this is a perfect example. All right. So we have this first wave move 1 down, 2. All right. And then we had this clear wave 3 down. Right. And within it, okay, I have another 5 wave move down. And I believe that's what we saw yesterday. All right. We saw this third wave. And then today, or into the close yesterday, and then today, what have I labeled here? You can see here I've labeled this a wave 4. Now what's interesting about this, and if you're a 10 stock trader subscriber, you've probably heard me say a million times, wave 4s are very tricky. All right, and the reason that they're tricky is they can stop or extend at different levels. I tend to not like to trade wave 4s. You really want to trade those big moves down. You want to trade the wave 3s or the top of a wave 5 or the bottom of a wave 5, okay? So based on the rules of Elliott Wave, what do we have here? What principles can we say what are the probabilities rather of what could happen? And what we're looking at here is if this is a fourth wave, okay, so 1, 1, 2, yesterday marked the bottom of a 3, today marked the top of wave 4. Just before we hopped on, President Trump stated that the EU tariffs are going to be 25%. As you can see, stocks sold off on this news. This is classic wave 4 action. Hey, we have this rally. Oh, here comes this news action. Something else that Paul Tudor Jones stated was that price comes first and fundamentals come second. So before we hopped on, actually the entire morning, I was looking at this as a potential wave 4, okay? And then understanding that number one, we have NVIDIA earnings coming out later tonight, and then we have inflation data and GDP tomorrow and Thursday, or tomorrow and Friday. So this to me has a, classic wave 4 to wave 5 down. All right, now here's where alternatives come in. And this is, again, something that you're going to have to deal with when it comes to Elliott Wave. And I mentioned this last week in terms of the criticism of Elliott Wave. It is subjective. It is absolutely subjective. You will have to say, well, I think this is a wave 1. I think this is a wave 3. But again, you have rules to work with. You'll keep studying. You'll get some wrong. You'll get some right. And then it'll start to flow. So in terms of the alternative, okay, and I have this here in blue, is that the move is already complete. So what we're looking at here, okay, is yesterday marked the wave 5 low. Now this is where, again, you might want to trade every single wiggle. I would advise against that. You'll find out, what you like to trade. Maybe you like to, obviously the wave 3s are going to usually the biggest. Maybe you like to just trade wave 5s. You like to trade the tops and bottoms. You don't like to trade in between. But the point is the probabilities are going to tell you how much risk you should take. And what do I mean by that? Well, let's say that this is the 5th wave. Yesterday marked the 5th wave down, and this, latest move as we speak right now at 1 o'clock, okay, isn't going to make a new low into that wave 4, and we're, NVIDIA has good earnings, and okay, well, guess what? Then you sit back, you patient. I mentioned that to 10 stock trader subscribers this morning. We took a trade off SMH puts yesterday for a small gain, and I said, hey, I'm not willing to put on more risk ahead of NVIDIA earnings and then the inflation GDP. So if we take into account the Elliott Wave count, this is where we can manage our risk, okay? Let's say we get this wave 5 lower, okay? We have on other trades another trade rather, that would profit from this another 5th wave move down. We can cover, and then the probabilities are going to tell us that we're likely to get another bounce. Why? Think about the rules of Elliott Wave. 1, 2, 3, 4, 5 down, we get an ABC up, or some type of corrective move up. All right, so that was, I wanted to highlight that because, going off of last week, it was, I went over a lot. I understand that. I'm going to go over a lot today. I already have, and I know we moved pretty quick. But that's the way the market is. I like to move, I like to see the 1 minute, the 30 minute, the daily. I'll get into the dailies in a second. And then I combine all these things to have a framework of what is likely to happen. What are the probabilities? What kind of risk management are we looking at when we're looking at, all right, is this a 5 wave down or is this a 3 wave down? Well, we covered our short, okay? If there is a bounce and we get another drop, we're still good there. Then we'll cover, and then we'll focus on what's next. All right, let's also incorporate something that I did last week, which are the RSI and composite reversals and divergence, all right? So let me pull this up, okay? Now this is just the RSI. Now you can look at divergence, and again, divergence is when, we have this move lower in stocks, but the RSI kind of rallies, all right? You can see this very, very slight divergence here, all right? Yesterday, again, this is the 1 month 30-minute chart. You can see that on a chart here where we had this small move lower, or new low. Okay, this bottomed around 11:30 yesterday. Okay, but the RSI didn't. Okay, that makes sense. But what's more important, and I highlighted this yesterday, I highlight it often to 10 stock trader subscribers, are the reversals. Okay, so from this high on the RSI, look how it's making a higher high, but from price, it's not. And this is where I labeled this wave 4 this morning. So you can see how all this kind of comes through, okay? I'm going to jump ahead to Fibonacci retracements just for a second. I'm going to cover other things as well, and go back to the basics of Fibonacci, but this is important. Usually what you'll see are wave 4s tend to end around the 38.2% Fibonacci retracement levels, all right? Okay, and so let me just go from the top here and I'll show you. Now, some of these lines are hard to see. I apologize. Bloomberg doesn't do a great job having this, but I'm just going to highlight this for you so you can see it as clearly as you can. All right. So that black line, that's the 38.2 retracement level from the high on, what was that, February 19th to the low yesterday. All right, and then look, it stopped right at that 38.2% retracement level. All right, here's where we put it all together, okay? We have the RSI negative reversal, okay? We have the 38.2% retracement where this wave 4 likely stopped, okay? So this goes back to risk management. Where can we put our stop? Let's say you wanted to get short right here, right now. If you wanted to get short, you would put your stop right above that intraday high in the S&P at, let's call it 66,010. That's where you put your stop. It might not be right. Okay, maybe this is the wave 5 here in blue, you know, and we have this a bigger bounce. Nvidia has a better earnings, PCE data, whatever it might be. But the point is that you're protecting yourself and you're going by the rules of Elliott Wave. This is very, very short-term stuff, but this is how you can use any short-term stuff to your advantage, and it's a system. Okay, you're not guessing. It's not just, you know, throwing darts. Okay, it is using the tenets of technical analysis that that I use every single day, in real time, to show you how to profit and show you how to manage your risk. All right, so I thought that was really neat that we got this, you know, live. Because it has been, you know, rather boring, you know, kind of sideways choppy action for much of this year so far. But over the last week, that has changed, and this is where it really gets exciting. Again, you know, understanding Elliott Wave, and especially when we have this volatility, it's just clearer to see. All right. So now you can see here on this wave 4, we're dropping here. All right, we're dropping down. So is it Nvidia? Is it a retaliatory measure from the EU around tariffs? Who knows? I don't really care why. All I know is that the technical framework that Elliott's telling me is that this is likely a wave 4 to wave 5 down, and then we'll probably get some type of bounce. Okay. So this is Elliott Wave, Fibonacci. All right, let's go back to Fibonacci. Now, what's important, and Fibonacci is just a mathematical calculation of taking a high, taking a low, and then markets tend to find resistance or support, depending on, you know, whether you're looking at an uptrend or downtrend, around certain levels. I mentioned the wave 4 tends to stop around that 38.2%. This is a real live perfect example of that. Okay, again, if you wanted to get short, you could do that here with a stop, you know, and trade that last leg lower for that wave 5 move down. Okay, now how do you measure Fibonacci retracements? All right, let me jump out of this real quick. Last week, this is a weekly chart of the S&P 500. You know, going back to 2007, 2008, we looked at this as just again the overall framework. Okay, but I want to show you, because most people, what they do, and there's nothing wrong with it. Okay, but I'm going to show you some better ways to hone in on using Fibonacci retracements. So most people will do this. They'll come in here and they'll say, okay, so this was the top in 2007. They'll come down to this first low that I've labeled 1, and they'll go from the extreme high to the extreme low. You can see that here. I've labeled that. Let me zoom in here. Okay, so you can kind of see, right, this extreme high on October 12th, 2007, and then this extreme low here, March 21st, and then we had this bounce. Well, again, some of these are hard to read. Let me zoom in on these for you. But what you can see is that, you know, it's not always going to be at the exact 50% retracement level or the exact 61.8 retracement level, whatever it might be. But what it does tell you is around a certain level. Okay, so you know, this is fine. One way to do it. There's nothing wrong with that. But let me show you another way. All right. A better way, I think. And this is what we call a Fibonacci confluence zone. Basically, I'm taking multiple Fibonacci levels and then placing them on the chart to see where a range, okay, a range of Fibonacci levels will tell me, oh, you know what, this is actually probably a place where the market is going to find resistance or support. In this case, we're looking at resistance. And what I like to do is I like to find highs and lows where the market traded for a considerable amount of time. All right, so if you look at these two charts, or if you look at this chart here, this is a weekly time frame, right? So I'm not going to just do the extreme. Yeah, we can do the extreme again, and I'll put that here. Okay. All right. Now let's take it from the top, but let's take it from where there's a price where all over a 3-week period it all tended to trade. Why? Because that's where there was a lot of activity. All right. It wasn't just the extremes. So I'm going to place this here, and you can see I'm not using the extreme. I'm using where 3 different weekly charts had similar price action. And then when I scroll all the way down to the bottom, okay, I'm going to do the same thing at the bottom. I'm going to end it, not at these extreme lows, but where there's a confluence of 3 weekly time periods, just like the top, 3 and 3, where there is, a lot of support in this case, where the market found support and then rallied. So then look what that gives us, all right? I'm zooming in here, and if you were to just have, this is these, I know these green lines are kind of hard to see, but this is the extreme green line that we had, okay? Now look at these light blue, and these are really hard to see, but look how those marked considerable resistance for the S&P 500, and it wasn't just the extreme high and low. This gave me a better idea of saying, all right, I think the market is going to find resistance here using multiple Fibonacci retracements rather than just one. Let me give you another example. Let's zoom out here and look at, let's see here. We can use any time frame, okay? This is going back to the top in 2021, 2022, okay? And I'll do the same thing. All right, let's take the extremes. Yeah, okay, great. All right, now let's use, this is a great example. So use the extreme, and you really didn't get much here, okay? But when we looked at the 61.8% retracement, both of these, look at how the market couldn't really break out, okay? We had that extreme high pop, but look how all 3 weekly charts, or all 3 weekly bars, held below that 61.8 Fibonacci confluence zone, all right? Now you can also do this on support, and I think this is where it's going to get important, especially heading into this March-April time frame. If you've been following me, I mentioned it last week as well. This is where I think things are going to get important. All right, now let's do the opposite. Then let's do this in real time with what we're looking at in the market right now. And this is the S&P 500, okay? So let's take the Fibonacci retracement zone, or at least what I think is going to be support. Now there isn't a whole lot here, okay, in terms of extremes, all right? So this is where I'll take, we just looked at 2. Let's do 4. Let's see how this really plays out, all right? So I'll take the extreme from here, all right? I'll look for this double top here, and then I'll go down, on the bottom left here on the side of your chart here, I'll find where a higher low or lower low or lower high, somewhere where the market made an inflection point, I'll measure from that as well, okay? And then we can do it from, like this dip down here, September of 2024. That's important because that was a higher low, and that led to this rally. All right, and now I'm also going to incorporate, how this kind of plays out with Elliott Wave. All right, so now you're looking at this, and let's take one more. Let's do from here, and I like to measure from gaps as well. All right, so now you're probably looking at this, and you're like, there's way too many lines on this chart, and I agree. So this is where I would come in, all right, and I start to measure these confluence zones. And if you're a 10 Stock Trader subscriber, you've seen me do this, okay? So where I like to see is I took 4 different measurements from extreme highs, extreme lows, and then, gaps, lower highs. And now I go back into the chart, and I see where on the chart I see a confluence of similar retracement levels, okay? So, and then I start marking them, right? And look at how, and then I'll just go back and delete all these, okay? And this makes the chart a lot clearer, okay? I don't like to have a whole lot of lines on my charts, even though that's the proper way to measure it. So now look at what we have. Instead of having all these lines, all right, what I've added here is 2 areas. And again, this isn't, you don't have to be perfect. You don't have to get right to the, the last cent of where the market's going to bottom or top. Is there a range within the market that you found where, hey, this is likely to be a low? All right. So this is what I'm looking at in terms of two different levels based on the Fibonacci confluence zone from the low in August and September up to the recent highs. All right. Then we start tracking in, how does this play out in terms of Elliott Wave? All right. Well, let's do that. All right. So to me, this looks like one, two. This is a somewhere in here we have a 3. I think this is 3, and then this is a complex correction. I mentioned that to 10 stock trader subscribers, and then we have this 4. Now, does that 4 end here in this confluence zone? Does it end here? That's where we have to see. This is where wave 4s get tricky, but this is also where we understand time. A lot of folks, a lot of analysts like to use only Fibonacci, Elliott Wave, and I think they're missing a big portion of analysis by not understanding time. Okay, so I've been preaching for a while now that the end of March, possibly into late April, okay, is a significant time factor. All right, we've been talking about this in 10 stock traders since probably July of last year. All right, so how this Elliott Wave plays out. But this looks to be a wave 4, okay, because we can't break out, right? So then I incorporate those Fibonacci retracement levels and say, all right, somewhere around here and within this March time frame, this looks like a wave 4 low. And then what do we have? We have this wave 5 higher, okay? We'll get into that in the weeks to come. Trust me, we will. But this is a longer term time frame of what we're looking at in terms of understanding Elliott Wave and then utilizing the Fibonacci confluence zones. All right, so I think that's an important thing. And then again, let's check back in on the short-term chart here. We can see this wave 4 hasn't broken out. We're coming up on 130. How does the market close? Strong or weak? If we rally back above where the tariff headlines come out, that kind of negates it. Probably tells me that this is a wave 5 and we have this messy bounce into the end of the next week, or in the end of this week, possibly into the end of next week. All right, let's get out of the S&P. Let's look at SMH. All right, and NVIDIA is reporting tonight. It's obviously going to be important. Everybody likes to look at it in terms of a leading semiconductor within a leading sector, which was the semiconductor sector. But as you can see on this daily chart, and I highlighted this to 10 stock trader subscribers this morning, this has just been an absolute mess. And so you might say to yourself, all right, Greg, well, where's the Elliott Wave principles within this? It's a mess. And it's not always going to be, this beautiful 5-wave move up and this, or, this panic 5-wave move down that you can trade. You're going to have these situations, these time frames where things just get messy. Here's something to keep in mind. When it's hard to make out, it's usually a correction. And so you can go back in here and see, literally from, July, from this bottom in August, it's just been a complete overlapping mess. That tells me, and it has been telling me for months, that we weren't going to have this huge breakout in stocks, in all stocks anyway, and that has proven to be the case. That's something that I learned many, many years ago, and it's very, very helpful. And that's whether it's a short-term, outlook. I don't know what's going on here. This doesn't make any sense. There's, a lot of overlapping. It's not breaking out. It's not breaking down. Probably a correction. So we can look at this and say, all right, we're looking at this. If you go back to the S&P chart that I just looked at, if this is a 4th wave within the SMH, looks a little bit different, but it's probably a bigger ABC correction off of this larger move. All right, so what I'm looking at here in terms of SMH and NVIDIA, again, let's say that this is today is that this wave 4. I looked at the S&P 500. Maybe we get this drop. We can see here I have this short-term trend line. Maybe there's some stops down here. We trigger that low, and then we get a rally. That gets us into mid next week, maybe late next week, and then we get into the important time frame of late March. That's something that I'm going to be looking for as an opportunity to go long, if that is the case. Again, maybe late April, but to me, the risk is too good to pass up in terms of switching from short to long, heading into that time frame. All right, let's look at let's look at NVIDIA while we're at it, since that's going to be reporting tonight. And what we can see here, and you can see I've had this Elliott Wave count on here, 1, 2, 3, 4, 5, okay? And now we have this overlapping mess. That tells me it's a correction. Now, what's the bullish, the very, very bullish scenario for this? And I don't know, I don't think that this is going to be the correct count, okay? But it is something that at least made me cover our SMH puts yesterday. If this is a first wave up, this would be a 2, okay? Or excuse me, wave 1 up and then a wave 2, and then we had this huge breakout in a wave 3. I don't think that's the case, but it's something I have to consider. It's also why, you know, I don't have a ton of positions on right now, okay? However, the most likely scenario, if we take into account what's happening in the S&P and then the larger SMH outlook, is, you know, maybe NVIDIA can rally here, okay? We saw NVIDIA rally late last year, but it just couldn't break out even after decent earnings. Maybe we see the same thing again, all right? We get this rally, whether it can break above, you know, this resistance level or not, you know, who knows? But we have more of this correction, and this is not a wave 2, okay? You know, and this gets us into that late March, possibly late April time frame. And then this entire move from NVIDIA completes, and then we have this rally, all right? Within NVIDIA, let's look at TSM. And this is Taiwan Semiconductors. And as I mentioned last week, I like to look at everything within a sector. I like to look for as many clues as possible, okay? To see, you know, is one stock or one sector giving me more clues than another, all right? Now, I was looking at TSM this morning, and sometimes you'll see, like Caterpillar, for instance, I highlighted that last week. I'll look at that again today. Sometimes you'll see some stocks bottom before others, all right? And it gives you a clue. So let's take TSM, for example. Let's say this is 1, 2, 3, 4, 5, okay? What comes after 5 waves? A, B, C, okay? So if this is the case, let's say TSM has bottomed first, for whatever reason, doesn't matter, I don't care why, all right? Or maybe it drops one more leg lower into the 200-day moving average here, down here, all right? And then we get a first move up, all right? And let me zoom in on this for you. I can take this down. Okay? So if this is a first move up, okay, or ABC, and then we have, what I'll be watching is, again, whether it's 187 or around 180, around the 200-day moving average, doesn't really matter. But this looks corrective to me. So we can have a drop lower, all right, and then we get a rally. And if we take into account the end of March, let's say, and Taiwan Semiconductors bottomed here in late February, early March, while an NVIDIA or you know, a Micron or SMH, you know, actually makes a new low, but TSM doesn't. This is where we could actually see something where Taiwan Semiconductors, maybe it's NVIDIA, it doesn't really matter, starts to take off first. If the semiconductors start to take leadership again, that's when you know you have a bullish setup. So Taiwan Semiconductors is something I'm going to be keeping a close eye on. We can look at Micron. Micron's had some nice moves over the last few weeks, but again, you know, you can see here, this has just been a complete mess. I mean, just a complete mess, right? It was leading, you can see here, it just topped in June and had this big drop. Okay, it's gone sideways since August. Okay, similar to SMH, it hasn't really done much. All right, so when this tells me it's a correction. All right, you know, this could be a significant top. We look at AMD, for example. AMD topped in March. All right, this has fallen by the wayside. Obviously, the market does not like what's happening in AMD, whether that's due to, you know, NVIDIA, TSM taking over. It doesn't really matter why. The market's telling you based on its price action, it is not keeping up with the rest of the sector. That's a problem. All right, so again, but you can see here I have this, you know, this A, B, C, D, E. This kind of gets into more complex corrections within Elliott Wave. But, you know, we could see a situation where everything starts to bottom here in March, April, based off of this price action. So NVIDIA is obviously going to be an important, it's an important stock, but it's also more important for me for the bigger picture. How does this play into the bigger picture? Okay. And when we talk about the bigger picture, something I want to highlight finally is bonds. All right. So we saw, this is the iShares 20 plus year bond fund. Okay. And we saw a nice big rally over the last couple of days as stocks retreated. So if you listen to the news, which I don't, I mean, I see the headlines, but I don't watch any CNBC or Fox Business or anything like that. It's too much noise for me, okay? And they're usually behind the curve, and they also have to come up with some type of reasoning. They like the why, okay? Excuse me. The why in here is that, oh, there's a growth scare. And so bonds are rallying as interest rates drop, and then stocks are doing it as well. I don't know if that's the case. I highlighted to 10 Stock Trader subscribers this morning that there's a variety of factors. What are we looking at here? Are we looking at potential peace with Ukraine and Russia? Are we looking at inflation data that's actually going to come down, and the market's starting to, the bond market specifically is starting to sniff that out, and stocks have it wrong. Bonds tend to turn first. Okay, so I highlighted that. You know, TLT bottomed on January 14th. You can see that here, and now we're rallying. Now, what's also important here is that we can see that RSI is getting into a little overbought territory. All right, but let me show you the weekly chart of TLT, and I think this is very, very, very important. And then I'll combine Elliott Wave, Fibonacci, you know, and we'll also look at some reversals. All right, so this is a weekly chart. You can go back all the way to the COVID crash. Again, you know, this topped in March. We had this huge move down, and you can see here, this move in back in 2021, 2022 was a clear wave 3. Okay, and whether that ended here and this is A, B, C, D, it doesn't really matter. The point is that this was this huge move down. Okay, and now what we're looking at, are we looking at a considerable or an important bottom, at least short term, or you know, medium term, if you want to call it, bottom in bonds, where interest rates are going to fall a lot. The why, again, I went over some of the whys. We'll see how that plays out. But this is what, sorry about that. All right, this is what we're looking at in terms of the longer term picture with TLT. All right, so we have this weekly chart, and you can see here I've highlighted this 1, 2, 3 at the bottom. So bonds have made lower lows, okay, but the RSI is actually sloping up. This is long-term positive divergence. Now, I was looking in early January and parts of February that if bonds started to make this new low, okay, if it made another low below 82, that, you know, and the RSI didn't, that was a huge buying opportunity. It didn't happen, but it still could, and I'll show you why. All right, so from this high, you can see here this wave 4. All right, let's track our Fibonacci retracement, okay? And what I want to show you is where we are stopping. So you can see here, if you go to the extreme high, the extreme low, you're not getting much, okay? If you go from you know, a double top, you're not getting much as well. But what we could have here is, if this is and bonds are rallying as we speak, again, maybe this is tariff stuff, okay? If this drops to a new low, and that happens within that March-April timeframe, along with stocks, that probably tells me that both have bottomed. Here's the other scenario. Look at what we have on the composite index and on the RSI. And the RSI is not as clear. It's a little, let me show you the composite index first, okay? And what we have here is a negative composite index reversal. And I'll show it to you on the price chart as well. All right, so let me highlight this for you and blow it up a little bit so it's easier to see. And as our 10 Stock Trader subscribers know, this is very, very important signal to me. Okay, so this on TLT on the price chart, you can track with me here. Okay, we had this high back in early December, and then we have this lower high as of right now. This is sloping down. Now go to the same 2 points on the composite index, and you can see that this is sloping up. This tells me, at least on a short-term basis, that we could have this big drop in bonds and a rally in rates. Now, how does that correlate with stocks? That's what we have to see. That's where it's like, hey, we're also getting this short-term low in the S&P 500 potentially. We have earnings with NVIDIA and PCE, then the Fed meeting. I mean, there's a lot of big catalysts. But how this plays out after the fact is going to be incredible trading opportunities. I've been talking about it for weeks now, and I'm very, very excited about it. And I'm not really concerned which way it goes, as long as the fact that, well, I am not concerned about it. I have a probability of what I think is going to happen. But when I put all this together, this is kind of what I'm looking at, all right? So what can we look at in terms of what's going to happen next? Now, if TLT, this is where it gets really important. If TLT rallies above 94.85, all right, this is negated. What else does that tell me? What's negated is the RSI or the composite index reversal, likely not to get a new low. Okay, well, if that's the case, then what are we looking at? What the case is that bonds have already bottomed. All right, this low in early January, mid-January, whatever you want to call it, that was the bottom, and now we're looking at a lower interest rate environment, and whether that's the Fed, whether that's tariffs, whether that's new peace, whether that's lower inflation, maybe it is a growth scare. Okay, if that is the case, again, I'm not concerned with why bonds are bottoming just yet. It's more about how does this correlate into the stock market. So going back to what I said earlier, we could see something where bonds bottom first, and then if we see this, whether it's whatever scare it might be, where we get another leg lower in the S&P 500 to complete that complex correction, the bond market doesn't make a new low, that creates divergence, and then we see bonds and stocks rally together. I'm not sure yet. Okay, do I want to get crazy long or short the bond market right ahead of important inflation data and the Federal Reserve meeting? Probably not. But depending on what happens after the fact and incorporating time, that's where I do. So I think this is a very important thing to look at, or aspect to look at, and we're incorporating the longer term Elliott Wave. We're looking at Fibonacci. We're looking at this potential composite CI reversal. All right. Now, I also like to mention that we look at NVIDIA and TSM and Micron and AMD all within SMH. What do we do within bonds? Well, we do the same thing. Okay, so the TLT is a 20+ year bond fund. All right, and we're rallying here. All right, well, let's actually look at the U.S. 30-year bond futures. All right. Can we gather another clue? Okay, see, the chart looks a little bit different than TLT does. All right, we can see here, it's starting to get a little bit overbought on these 30-year bond futures. Okay, it's approaching the 200-day moving average. Can it break above this swing high, similar to TLT? All right, and then we get a drop. If this drop happens into late March or late April, whatever it might be, and bonds don't, that creates the divergence. That likely sets up something to buy. We can also look at, the actual interest rates themselves. We can look at this is the 10-year interest rate, U.S. interest rate. And you can see here, I kind of had this Elliott Wave count. This is the aggressive count, which did not play out. So now we can see here on the 10-year, right? This is approaching the 200-day moving average. Does the 10-year drop below this 412 level? All right. RSI is starting to get into oversold levels. Same thing with the composite index, where we have these PCE data, we have GDP, we have inflation numbers, we have the Federal Reserve meeting coming up. These are going to create a lot of volatility and incredible trading opportunities. Right now, I'm just being patient to try to see which one has the most probability. Do bonds drop, interest rates rise one last time to create that low in TLT, as I mentioned here? Okay, do we get that one last? It's an inflation scare, it's war, whatever. I don't know what it's going to be. Do we get this one big drop? Maybe the Fed is on hold when many people think they're going to cut. We don't know. Does that create that type of fear that brings stocks and bonds down? Okay, to then create, the opposite effect. All right, where the fear is actually a buying opportunity in both bonds and stocks, or has bonds dropped, bottomed here on January 14th, okay, and then any scare that we do get, it does not break that low. Stocks have divergence to bonds, and then we rally. Those are the two highest probabilities that I have right now. All right, so that's a good overview of Elliott Wave, and then including the Fibonacci retracements, the confluence zones, support, resistance, and then also factoring in the composite index and the relative strength index. So if there are any questions, I'm happy to take some. We have about 15 to 20 minutes to take some. I'm happy to go over some specific charts if you want. Remember, I can't give specific trade recommendations or advice, but I'm happy to go over any questions that you guys might have. Let's see here, waiting on a few. Yeah, so bonds keep rallying here as I'm speaking. So we're gonna check to see how. Again, this is going to be very, very important heading into the next couple weeks. A couple questions. Does oil and energy play into your macro view? Yeah. So I'll look at oil here, and this is crude oil, and I look at oil. It's not something that I trade all the time. I don't trade it in 10 stock trader. There isn't a good, there's not great ETFs and stuff to be able to trade that, but I do look at it, but you can see here, this has just been an absolute mess over the last year or so. Okay. You can see here, going back to 2023, I had some, some Elliott Wave counts. I mentioned specifically last week, there are some markets where I think Elliott Wave is fantastic. There are some markets where it just doesn't make sense to me. I know plenty of guys and gals who trade oil and use Elliott Wave to do it, and that's great. I just got another question real quick. Do I use futures? I will not use futures in 10 stock trader. I only trade options, stocks, and leverage ETFs. But back to oil real quick. So you can get a gauge of, all right, is it inflation driven? Is it growth driven? Is it a scare? Right? Is oil going to drop because no one's people are pulling back? There's a recession, or is oil rallying too much and it's causing inflation? But one thing I learned trading at Campbell and Company, and I traded oil, is you're trading up against the OPEC cartel, if you will, right? Pick whatever country you want to target, but they're going to have inside information about what's happening in the oil market before you do. Now, you'll see it in the price action. You'll see, I'm not saying that you can't make money on it. I'm not saying that at all. I've just found, my niche, so to speak, is much more focused on stocks, bonds, precious metals, and foreign exchange. I don't get into as much with some of the future stuff. I'm really not going to cover soybeans or wheat or anything like that. I traded them in the past. But right now, so oil is dropping. Is this based upon the Ukraine war possibly ending, inflation coming down, production ramping up with President Trump's policies? So there's plenty of reasons to why. To me, with oil dropping, this would be great for inflation. So, if I think about that in terms of, March, April timeframe for stocks, to me, that's a good sign. Will you cover symmetrical moves at some point? Yeah, absolutely. Actually, we can do that right now. So I was looking at this in TLT, and basically a symmetrical move is you'll see these symmetrical patterns specifically in corrections within the market, and similar to Fibonacci retracement levels. Okay, what I want to do is look for moves within any market, okay, and see if there's some type of symmetrical move. So I can take this low in TLT. And again, this was something I was looking at this morning, and I will expand this out so you guys can see it better. All right, so I take this move, right, from this low, January 14th, okay, and I go up to a high, all right? And then what I want to see is this a symmetrical move? Yeah, look at that, right? So then I take this odd move that we had, we actually traded. We traded TLT puts there for a nice little gain, okay? But you can see how this move, this first box, okay? And I'm looking for, I don't care what the point number is, I'm looking for equal legs, okay? And usually that's in ABC within Elliott Wave. So if I were to label that, this would be A, and then this bottom here is the B, okay? And then we have this C. Now, you can see here that, you know, maybe it rallies a little bit. Again, I'm not looking for the exact penny. Is there a symmetrical move that is possible that also plays into the Elliott Wave? So if I go back to this high, you know, is this a fourth wave on this C wave, and then we get that fifth leg lower? That fifth leg would also be incorporated into the S&P 500, you know, bigger correction. Could we do CAT? Yeah, we can look at CAT, and I think Caterpillar actually has a symmetrical move as well. Okay, and oh look, there you go, it's right there. So this was at the top after the election. It topped on November 6th, and you see I'm tracking this symmetrical move. Now you can see again, it dropped a little bit below there. I'm not really concerned with getting the exact penny right. Okay. But on the bigger move, what else can you see? I have it labeled here, right? This could be the big fourth wave. You can see the RSI is starting to bottom, okay? You can see the composite index. This is important too, okay? This is starting to make, you know, higher highs or higher lows, excuse me, all right? I also mentioned how a stock like TSM could bottom early. Caterpillar could be bottoming early as well. This might be a sign. Maybe Caterpillar drops or has bottomed or bottoms over the next week, while other stocks it takes into March. This is something that you know, we'll be trading, even if you don't have to trade it. Okay, the option liquidity in Caterpillar isn't the best, but it's still something that we could trade, or at least say, hey, look, this is a signal, but we're going to trade, you know, UPRO or SPY or the Dow or UDOW or something like that. So yeah, you can see how we've incorporated symmetrical moves, also looking into, you know, Caterpillar. Should I draw the divergence lines off the curve highs or lows? So the divergence lines, you know, so you can see here I've done it off of the extreme highs or lows within a move. You want to look at it relative to what's happening with price. On any given individual stock, what parameters are included in the stock's composite index, and what exactly is it measuring? The composite index is it's just a momentum indicator. Okay, it's looking at the momentum of the stock itself. Okay, so it's not the parameters. I'll have to go back and honestly look at exactly what it is measuring. Okay, but even if you don't know what it's, you can take anything you want, MACD, RSI, composite index. What you should be looking at is not necessarily exactly what it's measuring, but trying to understand where the signals are. That's what I care about. What are the signals of momentum using the relative highs and lows between price and whatever indicator that you have? We were expecting a huge pivot at the end of January that did not happen. Do we know what happened? Expecting a huge pivot at the end of January. Well, I mean, we did get a pivot. You can see here, Caterpillar topped January 24th, and then we had this big drop. You know, you can look at a number of stocks that, you know, so we can look at here's the NASDAQ, okay? We had this, again, this top January 24th as well. You know, yeah, we had this rally, but this is where it gets to be, this is where GAN analysis sometimes gets a bad rap, and why I continually stress, I don't know whether it's going to be a massive move or it's just going to be a short-term inflection point. Some tend to be, this is why you have to incorporate Elliott Wave and time together. So what I would say is maybe January wasn't as big as we might have thought, but what I will say is that March, possibly April, will be bigger. So that's something that we can look forward to. I'm definitely looking forward to that time frame to trade. Okay, if there's no other questions, it doesn't look like there are. So we'll see what happens with Nvidia tonight. We'll see what happens with inflation. Then we look into the Fed. So again, thanks for joining. I think there are going to be a lot of great trading opportunities. It's going to be also great to follow them live on this show. Thanks for tuning in, and I'll see you next week.